The bear market is dead, or at least that's what the financial media said this morning when I got to work. I'm Steve Van Metre, and thank you for joining us. It's Wednesday night for our 15-minute look at what's going on in the markets and how it affects you. All right, so again, the financial media is declaring bear market's over, and if this was true, and I apologize for finding some humor in this. If this was true, we had a 2-month bear market, the shortest in history, or 3. I mean, realistically, where do they come up with this stuff? But what it does do is it brings people back in the market. Now remember, the financial media is never your friend. When they say buy, you sell. When they say sell, you buy. And notably, they never tell you to sell. They always tell you when to buy because, well, that means somebody else behind the scenes who owns the financial media is selling. And so what actually is happening in the market, we're starting to see this data and people are starting to come out and talk about it, is when Steven Mnuchin called the CEOs of 5 major banks day before Christmas Eve, and when he called the Fed and all the other people in the government the day on Christmas Eve, which was referred to as the plunge protection team, although the government can't buy stocks. I know a lot of people think they do. They don't. I mean, there's absolutely no evidence that this is occurring. But anyways, what happened, and now we start to see it, is the CEOs of some of these major corporations came in and they started buying up some of their stock. Essentially, it was kind of like, hey, take care of this problem. Well, obviously, these executives don't want this stock because they've been selling it. And so as soon as, the moment their corporation ended its blackout period for buybacks, pedal to the metal, they're just hammering as many buybacks as they can possibly stuff into the system within their legal limits. There is a period that they look back, and I want to say it's 4 weeks, but don't hold me to that. But they can buy back 25% of the average daily volume over a backward-looking period of time. And no, corporations cannot bid up the share price. They have to, when they go into to buy, they have to bid essentially at market value. They can't, say, oh, I'll pay $5 more. Nah, it doesn't work that way. And so some investment banks have come out and said, yeah, well, it's the corporations are just, really just buying more stock back right now than they did the same time last year. And what happened last year? Stock prices ran up and then collapsed. And when they were asked, well, is anybody else buying? They said, no, everybody else is selling. All of our clients are selling. And that would, of course, include the executives, CEOs, board members, all the large holders of stock. And they're obviously frantically selling because they're buying at a much faster pace than last year. So why would corporations do that? Pretty simple. See, the reason corporate executives are considered the smart money or the insiders is because they know minute by minute what's going on with the company. So let's say you're an auto manufacturer. The public doesn't figure out cars aren't selling until they see them lingering on the showroom floor and the dealer lots. But the CEO knows day by day, probably hour by hour, where are sales at? Where are they at from a year ago, last one? They know exactly what is going on everywhere. That's part of the reason smart money. The banks are the really smart money because they see everything. They've got everybody's bank account. They know what's really going on. So all of a sudden, we get this declaration that the bull market is over because the S&P, for at least one day, has reclaimed its 200-day moving average. We'll take a look at that in a moment. The other excitement happens to be not with the government shutdown almost being over, and it looks like it is, not with the trade war with China that President Xi is actually going to show up in the meetings, I think on Friday or Thursday, I can't remember which, but he's out of nowhere decided to show up. President Trump said, no, I'm not meeting with President Xi in March, which was planned. I won't say it was planned, but it was expected. That's not happening. Now, we have to assume that there will be some window dressing put on this thing. The total trade war is not going to go away, but both sides are hurting. And sometimes you take some time off and maybe, see if you can figure it out. But the exciting news is the Fed has said that they're working on an announcement of when their balance sheet unwind is going to end. And this is really interesting because a lot of people think it's ending tomorrow, and it's not. So we have to go back and look at what did Fed Chair Jay Powell said. He said the balance sheet will be lower than today, but higher than it was in 2008 when we started this. In 2008, it was about $1 trillion. Today, it's pretty much about $4 trillion. So let's split the difference and say, well, it's going to be somewhere in the middle. So it ends up around $2.5 trillion. Well, that means at the current pace, we've got like 3 more years of balance sheet unwind to go, maybe a little more. Not good for the stock market, but everyone's hoping that this is the end of the balance sheet unwind. And I don't think they're getting off that easy. I think this thing's going to keep going until the stock market takes a big nosedive along with the economy, and then the Fed stops. The Fed isn't going to stop now, not with inflation numbers sitting kind of where they're at. There's no reason to do that. The content of this video is provided as educational information only and not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. Opinions expressed video that do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So yes, everybody hoping the Fed's going to back off. Not going to happen. Today's consumer price index numbers show a decrease, but this is going to all be passed off on the government shutdown. You watch and see. They're going to say, the data was a little soft, but the economy, was in a shutdown and the trade war. So they're going to kick this can down the road a bit. By then it'll be way, way too late. The balance sheet unwind has not stopped. The data is still coming in, showing the Fed is still unwinding. And so with that, let's take a look at some charts and just see what's going on in the market. In fact, let me get my charts reset here so we can take a look and see. All right, here we go. So let's start out with the S&P 500. Looking at a 6-month chart, it crossed over this heavy resistance zone at 27.35, only because it needed to touch its 200-day moving average yesterday, and it closed pretty much right on it, slightly above it, slightly depending on one of these things you look at. We can look at the futures, and it closed below it, so that's what most people in markets look at as the futures, and here's its 200-day moving average. It closed below, so we'll say that this is below, even though on my chart here it's saying it's slightly above. And just like we've seen in the past, when the market got to its 200-day moving average, it struggled to get over it. So what did the computer algorithms do? They did a move in overnight trading, and I'll see if we can find that here. So here's the futures market. So last night, let's see, which would be somewhere right in, no, this would be today, right in here, I believe is where, 5 o'clock, this is where it would have closed. And then shortly after close, boop, 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 up it went. On no news, there was absolutely nothing going on, but what the purpose was to get the market over the 200-day moving average, just like we saw here, just like we saw here. Now, why would the computer algorithms do this? Well, there are people who trade based on the 200-day moving average. If it goes over it, they buy. If it's under it, they sell. And so, you got to incite people to get in. You've got to create some good news. And so the computer algorithms jumped it over. And what happened the very next day? Well, the bear market's over. Clearly. Didn't you see it? It's over. So anyways, markets gapped up and over, and then you can see, even though it closed green, which was positive for the day, this candlestick moving down said that there were more sellers than buyers. So now we know this was corporate insiders pushing this up a little bit, knowing that they were going to put the pedal to the metal on corporate share buybacks, drive the market up, and then now they're selling. And so there you go. So the smart money is moving out once again. And as we know, we can go back and look at what happened a little over a year ago. If we zoom out, and market jumped up in January, everyone got excited. This is all the way going up, 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 and kaboom! As soon as the corporate share buybacks kind of ran out of steam, because they don't have an indefinite amount of money, and two, again, there's rules regarding how much they can buy. So at some point, the low volume lag in the system, just puts them at a point where, hey, there's, either we're out of money or we want to preserve some of this money going forward so we can buy back shares, next quarter or quarter after that and some other point. But as I mentioned earlier, the motivation to buy shares back now is the first quarter data is not going to look good, and the second quarter data is not projected to look good either. It's not from the government shutdown. We have a deceleration in the money supply. We have clearly global growth slowing due to the Fed. So all of those confluences come together and lead to a slower economy. And slower economy means lower revenue, lower earnings, and lower stock prices. So if you've got money in and you can control who's buying, as the executives can, you dump the money in and get your money out as quickly as possible. All right, so back to the charts. So I doubt this is going to keep running, but for the moment, the bulls are pretty happy that they got over the 200-day moving average, and long-term equity rallies run when prices are above their 200-day, so it's slightly there. On the weekly moving average, it's slightly above it. And we can zoom in and say, okay, yeah, it needed to get over this, but we can also look and say, hey, there's been weeks here where it got over it and then it was completely rejected the following week. So even if we get a close on Friday above, looks like 27.30 to validate a close over the 50-week moving average, it's got to close there and stay there and then move. It's got to get some momentum here. And the only question is, how much more ammunition do these corporate executives have to stuff into stock prices? Because the bond market is telling us that this equity rally is not real. It's real in terms of people, corporations are buying it, but it's long-term, being able to keep it running long-term is just not there. In fact, if we overlay, and we've done this before, we'll pop treasury yields on here. And you can see the S&P 500 follows bond yields. And it says treasury yields aren't up here. And if they were, treasury yields, and said this morning, should be around 3%. And there it is, right? Treasury yields should be at 3% today. If this move in the market was validated, the bond market is saying, no, don't see that happening. And so as a result, we know stock prices, again, are more likely to go down than up. And speaking of treasury yields, I kind of mentioned somewhere maybe in here weeks ago that we might see a sideways move until the 50-day moving average catches up to it, because we can look back and we can see that this thing kind of likes to follow its 50-week or 50-day moving average in green. And we can go back a little further and see that on the way down, it just kind of falls it. So sometimes the treasury yields fall and then jump way back up to its 50-day and go. Other times, like we see right now, it's just going sideways. And I'm guessing that in the next few days or so, maybe by this time next week, it'll run into its 50-day moving average, and that will be a big tell for the bond market. And we already know what's likely to happen because the banks are buying bonds. So that is going to bring yields down, not up. Let's take a look at a few other things. Let's see. 30-year yields, you can see the 50-day moving average much lower than the 10-year. And so here, it's more likely the 30-year yields are going to make the first contact and probably be rejected and stay below the 50-day moving average. What we want to see is a breakdown in treasury yields. Let's go back to the 10-year. This is where I think bad things happen for the stock market, is if we get another break below 2.6, we will. And the reason I think that is I was looking at 2007 earlier, I think last night maybe. So here's 2007. And a lot of people don't remember, but in 2007, October was a really bad month. Market dropped like 30%, and virtually nobody saw it coming. Now, a lot of people remember early 2008. They remember that, but they don't remember what happened in October 2007. It was the treasury market that led things lower. Let's quickly take a look at that again. And so here you see this big shelf pattern up here, and you can see treasury yields made a higher high, one last final higher high. They came down, jumped back up, hit the 50-day, because we're looking at a daily chart, and then broke down. And October is right in here, right here where my mouse is. And you can see there's this topping pattern where we can go all the way back and say, hey, yields broke down. And what happened? Stocks broke down. And it wasn't until yields came down further and then they provided some support that there was a rebound in the market, and then the floor fell out. Let's look at where what we have now, which is a high, another high, a higher high, a top, and here we are along this shelf. We'll zoom that back out, and you can see this shelf here is pretty important because once it breaks down here, it does move down fairly quick. And since the stock market, as I've written about, is a function of liquidity, and when you have a lot of people shorting the bond market at a record level and they get squeezed, they have to sell something to buy bonds. Well, if they don't have cash, which cash levels are very low in brokerage accounts right now, how do you do it? You sell stocks to buy bonds, and that's when opportunity knocks. All right, well, that's our update for tonight. I'll be back with you on Friday for our more comprehensive weekly economic update. In the meantime, if you have questions, give me a call, send me an email, post them on Facebook. I'm here for you. Bye now.